Hey everybody, JJ here, back again with another Wednesday Zoom networking for you. We've got a really phenomenal young man coming on as our guest speaker today. He's going to talk about money of all things. Just a great young man. I think the world of him. He's out of Pace Morby Step 2 community, one of the rising rock stars in Step 2. Um, he is a husband, family man. Uh, Not just started as a real estate student, but started learning how to do his own taxes, and actually has become a tax expert. Can help anybody all over the country, and has a heart of gold. I'd like to introduce my good friend, Mr. Tousif Rahman. Tousif, how are you?
Doing good. Appreciate all the great adjectives. I don't know if I can live up to all of them, but we'll definitely give it a shot.
Well, brother, I know you're constantly helping people in your educational community.
Yeah,
And
that's the goal.
yeah, and you just lead with your heart, and we've had multiple conversations. This is not your first time on the Zoom. You've been on before, and I think you're one of the nicest guys I know. Really, you just heart of gold,
Appreciate
kind,
that.
kind and genuine. A rock
Appreciate that.
star. You're a rock star. So, brother, hey, for those that don't know you, where in the country are you located?
I'm just outside of DC, Northern Virginia.
Beautiful place, and of course, the photo behind you is representative of your area, which I think is great.
Yeah, this is the Great Falls. So it's one of the, I guess, if you're in the Northern Virginia area, this is probably the place that you would like to visit. And of course, if you're into the fishing, not all of the places is good, but definitely need to check. Some of the areas are pretty good with fish. So depending on what your, I guess, goals or stuff. So definitely visit this area. I personally like this area myself as well.
It looks beautiful. It looks beautiful. Hey, so taxes are your thing, and we're going to get into that topic in a minute. You got into the real estate investment community of Sub 2. Many people know Sub 2 for the Pace Morby. Are taxes and real estate something you were always into? I mean, when you were coming up from your teens into your 20s, were you thinking about taxes and real estate, or were you doing something else during those years?
Oh no, I mean, I came to US 7 years ago. I didn't even know about that. I had to pay taxes before. So it's interesting that 7 years ago when I came in and I realized that, of course, people are making a lot more money. And all of a sudden, when I see the higher they make, the less they pay in taxes. So that's when it really intrigued me into looking into how on earth they do it. And interestingly enough, my first year, I made about $3,000 ish, and someone messed it up so bad, and I was on the verge of bankruptcy. That it became that bad. So that's when I started learning about taxes. Um, Started 7 businesses in 7 years. I know it
Wow.
sounds really crazy. Made money in three, lost in four. That's just how the business works. And eventually realized that real estate is one of the ways, or if not the best way, but one of the greatest ways that you can actually leverage the tax codes. Because irrespective of which party you voted for, Democrat, Republic, or whatever, but all of the people in there does invest into this. So you will see this specific area being very incentivized. And the more I read into this tax codes, the more I realized that tax code is pretty much catered towards controlling the behavior, or if I should say, financial behavior of people.
So now let
So
me
if you're
ask
looking,
you, because back to we met through Sub 2. So you were pursuing learning about taxes before you got into real estate investment, or did those things happen at
yes,
the same time?
I guess similar time because my education began more like into the business. I started, as I mentioned, some of the craziest stuff. I started FBA, failed in that. I started MLM. Not the best thing for me, but of course I learned a lot. But eventually, the entire thing on taxes, then I focused on formal education. And not only education from, hey, this guy says this guy says this, but rather actual education stuff to do tax planning, tax preparation, and such. Um, but one of the things that I started trying to do is implement what I learned. So say, for example, when I learned that real estate is a great way to mitigate taxes, I invested into real estate. I have creative deals under my belt so far. Then I looked into the different codes like starting other businesses, utilizing Section 179, get into the land deals. So, I mean, of course, in typical lands, as Mark was saying, that I believe Mark was saying that he also supplies petroleum or gas. So that's another great way to leverage real estate on tax benefits as well. And my background being in mechanical engineering, those were some of the interesting things for me as well. And now the fact that the tide is shifting and a lot of people are thinking outside of US. So now I realize that, hey, what if I had multiple countries as tax plannings as well? So now
Wow.
I'm actually being into different countries, starting other businesses, understanding what the tax consequences is going to be as a US citizen or green card, and then leveraging those and helping people out in US. So the difference between a lot of other traditional tax professional than I myself is they take it as a profession. I take it as a passion.
Cool.
So
Cool. And they always say, if you love what you do, you never work a day in your life.
yeah,
You know?
that's why I'm actually even learning. Just before this one, I was on another educational courses on these aspects. And one of the biggest focus on education this year is international taxes for me. And as I mentioned, every time I learn something really interesting for me, I go out, I try to implement it myself, as well as I help people to plan them. And some of them, if not most of them, I personally have used it myself or helped someone to do it that I'm going
Cool.
to be speaking to.
Very cool. Yeah, we're going to get into tax strategies really quick. We got a question here. Let's bring Cindy on. Cindy, how are you, girl? Good to see you. Hey, so
Good
you're
to
on with
see you.
Toastif. What's your question?
I wanted to know because I'm interested in owning a property somewhere in Western Europe. So I wanted to know what countries you were looking into right now.
I personally am looking into Romania, Turkey, UK.
And
I'm
UK.
also looking into so there's multiple aspects of it. There's one being what citizenship or benefits that you get. My parents are elderly, so unfortunately, US is a great place to make money, but not always the best place to retire unless you have a ton of money.
Mm,
So, but Europe, in some of the places, if you have citizenships and such, that might be a very good place to retire.
yeah.
And especially in countries like Romania, you have 1% tax. So one of the strategies that I'm actually looking into is you having a management company in Romania and you being a marketing agency or whatever S corp or C corp you have, you pay yourself in Romanian company, then have the tax there. As long as you're not touching or bringing the money as a personal individual to US, that taxation stays there.
Okay.
So I need to, as I mentioned, I'm still figuring out the actual nitty-gritties of the laws
Yeah.
on those transactions. I'm going there in literally Sunday.
Okay.
So I'm gonna be meeting quite a few people. But some of the things like that are pretty interesting. As a US citizen, you're not touching it, that's when the tax benefit becomes. That's why you see Nike having different companies, Nike marketing, Nike branding, they pay from one country to another, while at the end of the day, they only pay 1 or 2% in taxes.
Yeah. Okay. Cool. I'll keep in touch with you in terms of what
You
other
have my
countries
number on
you're
the
getting to.
screen.
Yeah.
Yeah,
Sorry.
You have
you've
my
got
number
his
on the
number.
screen.
You have his
Got
number
your
there.
number.
And also we're going to provide, website, Instagram, all that kind of stuff later as well. Um, and of course, add him as a friend on Facebook and things of that nature. But we're going to make sure that we get you connected.
Thanks, Shelley.
Cindy, always good to see you. Thank you so much for joining us today.
The reason I raised my hand is some time ago, uh, Pace hosted an event. It was a networking event at Griffith Park where I met him and picked up the Wealth Without Cash book. And there were several people there. There were a couple that are in sub two, and they were talking about not just tax advantages, but how much further our US dollar goes in Bali, Indonesia. And I'm just curious to know if you know anything about the economy there and that sort of
Indonesia?
thing. Yeah, Bali.
Okay, yes. So Indonesia is a nice place. One of the things in terms of my vision is Hunger Free World. So that's one of my charity projects that I'm doing. So on the Hunger Free World, we do deal with quite a bit with Indonesia. So now Indonesia is a great place and also a risky place, especially how much risk tolerance you have. The reason that is Indonesia is constituent of 17,000 islands, and some of them are actually more considered as a mini kingdom, even though they have central government as democratic government. They have some regional areas that can vary with different laws. So Bali is a great place for making money, but exact tax breaks, I haven't been able to do that. All so far, my experience or dealings with them has been with seeds. They have pretty nice on those tropical areas. But in terms of just the regulations, Bali, as I mentioned, each state can have difference of regulations.
Got it. Thank you for that. I appreciate it.
And Ed, the Griffith Park event we had for Pace's book signing was, you know, Pace contacted SoCal's creative finance group, and I found that location myself. And so we had Pace's book signing there. And then for the last 2 years, we've had networking gatherings at that same location for over 250 people. So since you're local to LA, we're going to have one next June in 2025 of another 250, 300 people every June in Griffith Park. So stay in touch with me. Let's make sure you get to next summer's networking event.
Absolutely. Thank you. Thank you, JJ.
You're welcome, brother. Good to see you. So, Toasted hot dog, brother, we just might need to do a call on where you can retire around the world and what the tax benefits are.
That's a great thing. Another one of the channels that I'd probably recommend following is Remote Capitalist. I mean, of course, his stuff is really high level. Unless you have significant amount of assets, it's not worth it. But he does come out with some of the really good areas about retirements and such. Especially as Edward was saying, Bali's Indonesia's weather is really nice.
Yeah. I have
Food is
family that
really
work
good.
out of Bali. My
Yeah,
cousin's wife is from Australia. He's in Northern California, and they spend 6 months a year in Bali.
that's a great place, as I mentioned. But as I mentioned, the making money is still so far best in US. But retirement depends on what your preferences are.
I'm kind of looking at retirement myself, so we need to talk. Hey, we've got another question coming
Absolutely.
in. We have Dina Burrow. Dina, you're on with Toasted. What's your question?
Yeah, hi. I'm actually looking at a condo in Rotan, which is off of Honduras. And what you just said was very interesting. It's already in a corporation, and the money from the rent stays there. No money will come back to the US. So then you're saying I only pay the Honduras taxes for that?
No, whenever you pay it, sometimes you want to bring it back. So say for example, give you one of the examples of the filings that we did this year. She's from Australia, also in sub two. Uh, so dual citizen. Australian taxes are worse than US taxes so far.
Yeah.
It's good that sometimes we feel like, hey, we're bad, but sometimes we need to see that some countries are worse than the US. But what happened is when we did take the tax credit, so you need to file something called 1116, depending on how much and which country that you paid the taxes in. I don't want to go too much into details, but technically speaking, you pay the taxes, but you declare that here. Now, as a US citizen, you need to declare your assets overseas as well, which is under the FBAR and so on and so forth. That's where the trust and C Corp structure comes in. Of course, this is a little bit more advanced, but when it comes down to that perspective, if it's distributed as ownership of a US citizen, then you can take the taxes paid there, take the tax credit here, and depending on how much you paid, you can, technically speaking, reduce your US taxes. For this specific lady, her taxes dropped to zero.
Thank you so much.
Sure.
Okay.
Fantastic. Hey, Dina, thank you so much for joining us today. Well, great question. Before I move forward, talking about, investing in other countries, if it's the property is owned by a corporation, and I'll just use the generic word corporation, LLC, trust, whatever, although they can't bring the money back, can the corporation itself not invest in the United States, or how would those monies that get built up work for themselves?
Can be. So the word corporation, the way we US people use it, is sometimes different than the country of investment that you're looking at. So can it be? Absolutely. As a matter of fact, if you look into if any of you guys have investments in Vanguard or Robinhood, you've probably also seen foreign taxes paid on your 1099 investor dividends. The reason that is because they, as a corporation, investment corporation, they're all actually investing into different countries. So those taxes paid come into your 1099 dividends or interest, or however they're distributing it out, and you're actually taking a portion of it. So, I mean, most of the people probably have never looked into that 1099 form that meticulously, but if you're filing it or whoever's filing it, you probably have, if you're looking, I mean, I have seen Robinhood, I have seen Fidelity as well in some cases that does have foreign taxes paid. I've seen people in New Zealand, like one of the, I believe, former owner of PayPal invested 10 billion in New Zealand on some of the, I guess, critical infrastructure and such. New Zealand can be a pretty nice place as well, especially if you're into agro as well, leveraging some of the tax codes with the US and UK.
I'm very interested myself in learning how to invest outside of the country as well. There's, the opportunities are endless. I know people that have different types of vacation and recreational facilities in Central America, Costa Rica, Mexico, Guatemala, things of that nature. So let's get into the topic at hand, right? We're in November. End of the year is a blink away from us. The tax year is rolling up. Election day is behind us. And we're going to need to start thinking about our 2024 taxes. So our topic of today are tax strategies to wrap up the year. So
Awesome.
are these what you're going to talk about today, are these necessarily for individual taxes, corporate taxes, business taxes? I'm going to
A
say
little bit of all.
take it away, brother. Let's hear it.
Sure. So I appreciate you calling in me. I know I should have started this appreciation at the beginning, but just I didn't want to miss out on the Q&A part.
Yeah.
But to be honest, if you're talking about strictly individual does not have a huge benefits, unless, I guess, not benefits, but huge options. So the only options as a W-2, traditional W-2, is that you have something called the 529. If you have kids, you can put into 401k and IRA and those kind of retirement plans, just defer it. So, and also if you're like, hey, I already have bitten the bullet, maybe start an infinite banking plan. That might be a good way to get into those future tax planning as opposed to current tax planning. The moment I believe everyone here has read the Rich Dad Poor Dad with the 4 quadrants. So I'm probably gonna move from those 4 quadrants. So on an individual level, W-2, if you're having a 529, if you have not, maybe start one. If you have not had an HSA plan, maybe start one. Those are some of the very basic ones. Because previously we also had something called the conservation areas. Unfortunately, they are not as beautiful or sweet as it would have been previously. So we cannot really, I mean, you can go ahead and explore that, but as a matter of fact, I, being a fellow investor, I'm someone who wants to get a return on investment along with the tax benefit, not just spend for the heck of spending.
Yeah.
Of course, you can go ahead and, if you want to do a charity, that might be a great option as well. And as a matter of fact, you can start your own charity As long as you have a proper vision, you technically can contribute up to 60% of your income and even invest inside the charity as well. And that might be a pretty nice tax planning for being an individual. Now, moving into the self-employed, all of those does apply, but you can add to the aspect of self-employed's retirement plan. Close, if you're married, close to about 120,000 plus. I believe it's 166,000 each, so going to be about 132,000. These change per inflation, but that's the ballpark that you can look into. The other aspect of it is the moment you have from ES to B. As Mark was saying, he was having multiple businesses. I'm assuming some of them are S corps or C corps. In that case, what you could do is get the Augusta rule set up. So you have 14 days you can rent your personal home, and depending on which area, that can be a difference of $30,000 to $50,000 of tax-free money out of your business. So all you do is you have to be getting those, as long as you arrange meetings, legal business meetings, as JJ was doing events in his home. You could do the same thing with people who are planning on investing or such. Make sure to get a few comps on the square footage that you're planning on renting yourself to your corporation. And you can take that similar amount for 14 days without any tax consequences. The interesting part along with this is something that might be doable for all of the cases as individual as well who does W-2 is the short-term rental loophole. You still have enough time to buy a short-term rental, put it into service, and do 100 hours of it, significant service. So it's not just fixing it up before you put it into service, but when you do it, you put significant service like the maid service, the repair service, the maintenance service, and so on and so forth. As long as it's more than 100 hours, you are allowed to treat it as if it was an active business. Even though it's not an active business, it's called a short-term rental loophole, as long as the average stay is 7 days or less. And then technically you do the cost segregation, you take that deduction against your W-2 as well, and even 1099s. So this applies for both self-employed or W-2 employee. Coming back to the next one is, especially if you have corps, and if you have kids, look into the aspect of hiring your kids. Thanks, James. James pointed out a very important thing. It needs to be 100 hours or more, and no one else is managing it. So don't hire a management company for the 2 months. Make sure to at least do that 100 hours or more, and no other person does more than 100 hours. And of course, unless there's some other exceptions that come into play, these are typically the big pointers in the short-term rental loophole. The hiring of kids, of course, if you have kids before 17, you have them as dependents. So as long as you have the dependent threshold below that, and they're making that much of income as salary, that technically is a write-off for your corporation. But the fact that if they don't have to file it separately is pretty much keeping the money to yourself. Now, depending on how good your kids are, this might be a shot on the foot, but it might be something that very useful if your kids are not that bad as well. And you can actually start trying to look into their infinite banking as well. So say, for example, you start an infinite banking policy for them, and your premiums are going to be significantly lower. But by the time they're going out for their studies or even wants to invest, that might be a great strategy to take loans against the policy and pay for either their student scholarship or the education, or even they start a business or start investing into real estate. The guy with bigger pockets, I believe his name is Cody, he actually bought multifamilies for his kids. So these are not only tax-free elements, You're growing the things into your family, and you're still having the control. And by the time those kids grow up, they actually have a very nice cash flowing property for them. And if they want, they could take loans against them. And now all that money that she took as a loan is tax free because loans are not taxed. The next thing that I would probably also look into is the Section 179. If you have a need of vehicles or elements, so say for example, last year I filed for someone who is a truck driver and self-employed. So he bought a truck, which is the bigger trailers, so more than 14,000 pounds. And of course, depending on what type of businesses you are in, the three categories that you need to be considering is, especially of the vehicle, 6,000 and 14,000. If it is less than 6,000, Section 179 might not be the best way. However, beyond 16,000, 6 to 14,000, it's a decent place to be in because the cars and automobiles does have a cap. But if it is more than 14,000 pounds, that's a huge thing. There's a couple of other people in sub 2, they literally are buying private jets to offset that $1 million. So you have a cap of 1.1 and some change, so 0.1. So of course, those change per year. As long as you're below that threshold, you literally can write off that entire amount.
Let me ask you two things in relation to what you just said. Buying things in your kids' names, right?
Paying
I
your
hear a
kids,
lot of, excuse me?
paying your kids and buying things in your kid's name.
Well, buying things in your kid's name, for example. I hear about people buying the family home in the kid's name.
So when you say family home, is it for living for themselves?
Yeah.
Then it's not the best thing. I mean, let's take a step back. Is it the best thing? Depends. Is it the worst thing? Also depends. It's sometimes better to allow people to inherit, but the issue becomes people are not good at their estate planning.
You,
So what happens is they'll die, buying their own name, die, nothing in place, and all of a sudden it goes to the probate. And a lot of the people here are probably buying things in probate court. That specific step missing is something that makes it horrible. Now, if you're buying that one in your kid's name, you're technically skipping that step, but however, you lose the control. Now, how good is your kid? As good as he gets. And technically speaking, after 18, he can legally kick you guys out. So I typically prefer people to put things into trusts. They're much safer and does not need to go through the headache of the probate in any states.
I come from an Armenian family. I have an Armenian last name. And I hear a lot of times about people coming, as I say, from the old country. They come over here and they're buying. I mean, I think they want to show they don't have any assets. So the properties are being bought in their kids' name. And I just wanted to get your take on that. And obviously, uh, depending upon how it's structured, it could be good, it could not be good. And I think
Mhm.
some of their intention is to avoid showing assets.
So lack of showing assets is a good thing and the bad thing. So especially myself being an immigrant, say for example, when you are being an immigrant with green card and citizenship, you need to show some assets to grow your assets at the beginning. But when you are at a certain point that, hey, now I'm a few $1 million in net worth and such, I tell people just don't keep him on your name because now the issue is US is a very litigious country. People will come after you if they find something that is worth coming after for you, against you. So all you do is just move them into a trust. Now the issue is what happens. So say for example, in this situation, you bought your property in your kid's name. Your kid goes to college bangs up his car with someone, he sues it. Now you lose your primary house, or at least into the situation.
Mhm.
But now the aspect being, what if you could put it into a different type of trust? Now, neither do you own it, neither does your son own it. But both of you guys can be a trustee, a grantor, or a beneficiary, depending on the structure of the trust. That way, you guys still have the control over the asset, but technically not responsible for the asset.
Okay, no, that makes sense.
Might be a better way.
Yeah, and obviously for those that aren't aware, you do not want to own your personal residence in your own name. Put it in trust. Always, 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 never in your own name. Same thing for your investment properties. You want to put them in an LLC, and ideally put each one in its own separate LLC. Let me ask you, is you're the tax guy. People talk about, well, I don't want to. In California, we have a franchise tax fee of $800 to have an LLC every single year. So if you've got 5 properties in California, ideally you want them to be in different LLCs, but isn't that a tax write-off?
You can, but technically speaking, you don't always want to. So one of the things I have difference in opinion is,
Well, what I'm referring to isn't that $800 franchise tax fee a write-off?
yes, tax-free. Any state tax is technically a write-off. However, there's a limit. The previous government actually limited that to be $10,000 in state taxes. So say, for example, California being California, I filed someone's taxes, they had to pay $30,000 in property taxes. But all they could write off is the $10,000. So even if you had more and more and more franchise taxes, you technically cannot write it off because that's capped.
Okay. So I have to check into that because it's now property tax time, and I just got all my property tax statements for next year, and I'm like, oh my gosh, oh my gosh.
So
So
now, if you're a single member LLC, then yes, you technically cannot write it off on your personal as well. If it's a multi-member LLC and if you have $30,000 in property taxes and also the real estate, which is real estate taxes, and if you add up another 800 or whatever amount on income taxes, you technically are still capped. So that's the issue with state tax. So unless you have to, I don't recommend people do it. So
okay.
now, what if you had a trust set up in Delaware or Nevada or Wyoming? In that case, technically, you're still having the trust, and even though you're making the money in California, you're still paying the taxes in California, but you're not having the franchise taxes. But if you need to have California franchise taxes, you have to pay it, and of course you have to pay it.
Yeah.
But there are ways you can still get away without it.
Becca McKenzie. Becca, how are you?
Hi, Tousif. Thank you so much for being with us. Thanks for having me here, JJ. And thank you, Odette, for sending me the link. I tried to get in earlier and I just was in the waiting room forever. So this is an interesting, thank you, Odette. There she is. You're saying this about franchise tax and about how to hold the home and whether or not, as JJ was asking, whether or not you could write off the home, or if it was in the children's name, if that would be better. But JJ, I got kind of the slant to the question is, so we always resided in Texas when we had a family business. And our entire family business was operated basically out of the home. Well, at least my dad had an office at the home, and he also had his other office. So he was always commuting from one office to the other. His vehicle was 100% write-off. He didn't have to keep his mileage because he traveled from one office to another. Always. He was always going to an office. Didn't matter where he was going in between. He always ended up at an office. So I don't know if that's a Texas state law or if that was something his CPA did. Let's see, he opened the business in 73. And that's how it's always been. That's how we always write off. I mean, we write off all the food, we write off all the phone, all the electric, everything, because we all worked in the business too. And he also paid us. Well, I mean, when we were 3, 5, 6, 7, we were just giving truck drivers directions to the locations. We were taking down names and numbers. We were telling them how to turn on the rotator fan in the grain bin. We're telling them how to pull the calf out or whatever. You know what I mean? We're just like they would call farmers need their hand held a lot. But as far as we were helping in the business, so he could pay us for those things. Now, we never physically saw the money. He put it in an account and we went on all of our vacations with that money. And we would get a say of where we got to go. So that whole case scenario, is that something that anybody could do in any state? And back to the thing that you were saying about immigrants. I know that in Texas, some of our workers, we had to put the children as the owner of the home because they're the only ones with the social security number, or we could co-sign for the loan for them for a temporary amount of time until they had enough equity. Then we could turn it over to, but I like what you're saying about, was it you, JJ, that were saying that a trust would protect the whole family, depending on how it's arranged, who's the beneficiary, who's the grantor, who's the trustee, things like that.
I think
So
both of us said that. Both of us said that.
okay, yeah. Okay, so what about the situation where if the family is running a business out of the home, would that be a write-off?
Yes, of course. One of the things that you can definitely write off is the home office. Now, one of the things that I don't 100% agree is not to track mileage, is because even if you had it 100%, the mileage does give you an option to choose which one is higher. So unless you're absolutely sure that, hey, all we're doing is 179, we're only doing depreciate. After 5 years, there's nothing there. Okay, then that's fine. But what if that vehicle mileage was more beneficial than the 179 depreciation route?
That's a great point. Yeah, he always did the 179. So he would buy a 3/4 ton. It wasn't quite heavy enough. I know a lot of people say buy the Range Rover or buy a certain vehicle because it has to be a certain weight to do 100%. But yeah, every year he bought a new truck and it was 100% depreciated that year. He needed it.
Yes.
It was either do that or pay the tax.
Yeah, now, of course, if you're like, hey, after a certain period of time, now the fact, if you're selling the truck again or trading it in, now you're actually recapturing the taxes. So now what happens is now you're in the constant going back and forth on, am I going to be recapturing that amount?
Yeah, if he sold it, it was sold to the farm, which was a co-partner. So then the farm got the write-off again too. Anything that the corporation needed, the farm bought and they leased it to the corporation. Anything the corporation needed, the farm bought and leased it to. So it's 100% write-off.
Yeah, I mean, of course, can it be done? Absolutely. Now, Texas, being Texas, their children law is a little more lenient than California or New York. Technically speaking, you should be giving your children, which is in most states legally viable or doable thing. But Texas kids are typically, they're carrying guns at the age of 5. I've seen people. I mean, can it be done? Okay. But is it very normal? If you go into that same kid into New York or California, they're going to freak out.
Yeah, but we weren't carrying the gun. It's just sitting on the rack in the back in case there was a rattlesnake.
So again, that's the thing. Of course, as long as they're doing actual work for the farm or the business, then yes, you can write that off. I do recommend having at least a corporation structure. It's make things easier, but you can still do it on a simple LLC as well. But
no, his was corporate. So what would be the difference in the I mean, we did have a corporation. So I may have misspoke there because I know you're talking mostly of LLC. So can you clarify the difference between a corporate structure and LLC doing?
So now an LLC can be taxed as multiple things. So LLC is like a chameleon, which changes color as it needed. So can you turn an LLC into an S corp? Yes. Can you turn it into a C corp? Yes. But if you're not choosing to be any of them, then you just file it as an individual, which is sole prop or partnership. So that's the good thing, the ugly thing, and the nice thing about LLC. Now, being as a corp, depending on what type of corp, if it is a C corp, for C corp, you're completely separate from the corporation. You as an individual does not have anything to do with, let me not say anything to do, in most cases, anything to do with the person. So that's why you see a lot of big guys running a corporation, filing bankruptcy, they start another corporation. But you cannot technically do that if you have an S corp or a single LLC, because those are attached to you personally. On C corps, they're literally issuing dividends or distributions, and any other money is actually, in most cases, actual salaries. So as long as you're a salaried employee, of course, this is the gray or differentiating area between an S corp and C corp. C corp does give you the difference. However, you being, especially at the beginning as an individual starting out, they cannot really go ahead and go to the bank and show that, hey, my C corp made this much, I'm entitled to get the loan. No. So, but it's going to change if they have a single member LLC, because they're like, hey, I'm a sole prop. This is the amount that I make. So that's where the difference comes in. So when it comes down to tax planning, it's not just minimization of taxes always, especially myself being from an immigrant perspective. Immigrants sometimes need to pay a little bit extra taxes while the immigration process is going on, especially since I'm telling it because you're probably dealing with a lot of workers who are immigrant. Especially in that case, it is beneficial to pay a little bit extra. And the moment you have your green card or social security card, you go back 3 years, amend it, and get the money back. So that's exactly what I'm doing for my wife, because we got her green card. Now I'm amending last 3 years to get my money back that I overpaid. And I had to show it because unless you show them, you make certain amount of money, you're not able to sponsor them. So those are some of the things that you would ideally want to do that. And even in some cases, if you're trying to leverage the route of 203K, 401, the first time home FHA 203K strategy in real estate, that's a good place that you might want to show a little bit extra, but the rates that you're going to get is significantly lower than DSCR, unless you're able to secure a sub 2. So that's when it becomes a little bit tricky on tax planning. And hey, what's your goal? Like, I have people in sub 2 who only buys in sub 2. He's never going to touch FHA. So in that case, don't pay taxes. But if you're like, hey, I might go into FHA, I might be leveraging my current structure, then you're literally getting a couple of points less in interest, which is that might be the difference between making a real rental cash flow or not.
And so on that point, you guys talking about people putting the house in the kid's name, if you need to pull equity out, you have to show that the house is in your name. You can't be pulling the
That's
equity
another
out.
thing. The kid's grown, if the kid's making money, then it's all handy and dandy. You can't pull out the money. Like, say, for example, for the case of Cody of bigger pockets, I believe. He has so much properties. The small 2 properties that he bought under kid's name is not going to be a huge deal for him to cash it out or not. But if you're starting out, the way I started out, for me, I had to have the properties that I did cash out refi under my name. So now that I'm done with all the things, I'm now moving them into my trust. Can you do that? Absolutely. So now it gives you that protection on the legal side while keeping all the tax benefits and also the benefits with the aspect with the banks. Now, another thing that is going to come into with the corps is the corps are not going to get step-up basis. So that's why I don't always recommend putting properties, real estate rental properties in a C corp unless there's other benefits. So unless you want to do something in the C corp, which a lot of people do, that's why you see, even though some of the big corporations, they own commercial properties. It's because they're not thinking in terms of getting their personal taxes done or taking that benefits. They keep thinking on keeping those benefits within the corp. And if that's the goal, then hey, that's perfectly fine. Anything
Thank
else
you.
I could help you out with?
That's really perfect. No, that clarified it for me. Thank you.
Again, we're talking about tax strategies to wrap up the year. I wanted to ask a question because something got brought up about the automobile. Is buying a large automobile a tax write-off in every state? And what is some of a lot of people don't even know that you can get it's got to be over what, 6,000 pounds or something like that.
Yes, it's a federal tax deduction. So if you look into, and one of the things I tell people is just instead of trusting anyone blindly, even for myself, go ahead and start probably looking into some of the regulations. It's called Section 179. If you go into IRS website, it is going to break it down to every single details of it. And lo and behold, when I'm doing it, I'm going to be following that exact same thing because I'm not making tax laws. I'm just following tax laws. So
That makes complete
179
sense.
does give you, if you look into the IRS website, it needs to be more than 6,000 pounds. And of course, if it is just a regular automobile, passenger automobile, then there's a limit from 6,000 to 14,000. The type of automobile, then you have the cap. It does change every year for inflation. I believe it was 20,000 or 27,000 for trucks and SUVs and such. So these does change. So of course, those were previous years. It is going to change in 2024. So as soon as most likely IRS is going to shut down the e-filing in the next few weeks. So between now then and January 1st, they're going to declare whatever that amount is, and that's the amount we're going to be able to take for next year.
So it's not the whole vehicle. It's like 27,000 of the purchase of the vehicle.
As long as it's less than 14,000 pounds.
Okay.
So JJ, in my dad's case, the reason that even though it was only an F-250, which is not heavy enough, and because of his business, his line of work, he could put a welder on the back and his tools. And by the time he put the welder and the back and the tools, the value of the truck and the weight of the truck qualified. And I think we did that over 32 years. So I don't
Technically
think it was
speaking, now it's not just a truck, it's actually a modified truck. So
it's a work. Oh, I forget don't quote me on that. It's something about that it's a necessary. He built grain bins, so they did welding, and
yeah,
so
technically
it
speaking,
was
depending on what type of welding you do,
specialty. I think
vehicles, yes.
yeah.
So because depending on what type of welding you do, of course, not to bring my engineering side, I'm a mechanical engineer as well. But depending on the type of welding you do, some of the elements can be really heavy. So now, if you're turning into a different kind of assets, technically it's not just a passenger truck anymore. So that's why if you're buying a crane, it's not a truck or passenger automobile. So can you turn a F-16 to a carrier tow truck? You can, but now that's not a passenger automobile anymore. Hope that makes sense.
Exactly.
Perfect. Yeah, I just wanted to ask super quick, is there any benefit for nonprofits?
A lot. Is there any? A lot. I'm having my own myself. That's one of
Okay,
the
I'm gonna
things,
have to talk to you then.
that's one of the strategies that I personally am using myself. As I mentioned, anything that I'm learning, I'm implementing in myself as well as I'm teaching it. So technically speaking, with nonprofits, I mean, of course, for nonprofits, you have to have a proper vision. It's not that, hey, I want to save taxes, that's why I want to build a nonprofit. That's not how it works. But as long as, like for myself, it's a hunger-free world. That's my motto, that's my vision statement and such. And as long as you have an ordinary necessary thing, anything and everything, in many cases, even trips, can be written off. So even though I'm having travels across the world, none of them are going to be a personal trips anymore. So all of them becomes a business travel for me, and technically speaking for myself or my nonprofit as it's on the process. The issue becomes with nonprofit is it takes almost 10 months now to get the actual status with IRS, depending on when you're applying and such. But there's a huge benefits, traditional ways, creative ways. If you're E and S, you can contribute up to 60% of your cash contributions. And if you're doing the actual asset, depending on what type of nonprofit is it and how you're doing it, what type of asset is this, it can be between 20 to 30%.
Yeah,
And
I'm doing
even
the 501c3.
yes, so 501 itself has, I believe, 24 or 27 elements.
Okay.
So just because someone says nonprofit, I mean, but the default people here just think that, hey, it's a 501c3. Don't always come back to the 501c3. Now that I know that there's multiple things, I do recommend people to explore other options. If you think that three is the best way, go for three. Can there be other options which are better? Absolutely.
Okay. I was told to go with the 3 just because I'm gonna be dealing with HUD. That's why.
You were what?
Dealing with HUD,
HUD?
HUD. Yeah.
Oh, HUD.
Yeah.
Okay. Yeah, I mean, again, it's a very good place. Of course, 501c3 is a very versatile one, but that's when it comes down to the aspect of what you're going to be doing as well.
Correct.
If it is a political one, 501c3 might not be the best one. If you're leveraging your local politics and those kind of things, that might not always be the 3 might not be the best one, for my knowledge. So, and if you're trying to do hospitals and such, look into other options as well.
Okay.
So, like some people, one of my guys he's a veteran, so he's thinking of having a veterans retreat kind of thing. And of course, while 501c3 is a good one, but depending on how he operates it, 3 might not always be the best one.
Okay.
It's just a matter of whoever you're sitting with. As long as you go through other options and say that, hey, this is the best option, that's why my approach is. You find and see other options, what are the options, what are the solutions, and choose the best one.
Perfect. Thank you, my man. I took a screenshot with your phone number. That way I can reach out to you.
Sure.
Thank you, buddy.
Tousif, back to you, brother. You had said you had 2 more points you wanted to cover.
2 more things that I wanted to wrap up today is, of course, the S corp conversion. If you're like, hey, I am doing a lot of flips or wholesales, and you're just a single member LLC, consider having part of it as an S corp. What it does is, if you take salaries is still going to have a FICA tax, but the distributions you're going to have, distribution does not have a FICA tax. So technically speaking, you're saving 15.3% on part of your money. So that might be one of the things if you're actively making these kind of, or property management kind of things. So those kind of things might be one of the options that you look into. The last one is an R&D credit. So I really brought this one up because of the aspect of people here that we forget that how much R&D can be useful. Say, for example, someone from our team, I guess, mutual community, Astro Blaster, just came up with some new ideas. You come up with the same thing, but as long as you're producing something new that is going to streamline the entire operation, or come up with a system that is completely new and you're working towards it, all the money that you spend is technically a credit. So if you're thinking like me, even with e-commerce, I also have a little bit of e-commerce left business, especially the private label drop shipping that I'm trying to get this one off of the ground. But one of the things that you could do is, say, for example, create unique procedures, POS, CRMs, or AIs that is going to streamline the entire real estate business, your marketing business, your management business, even if it is like, hey, with a better communication with your tenants. So say, for example, someone that I was working with had an idea. If we as landlords reach out to tenants on a positive manner much faster on a regular basis, it creates a very good impression, and the rate of vacancy and or the rate of delinquency is significantly dropped. So what he ended up doing is creating an app with AI, or at least as I understood, is working on it. He's a software engineer, is to send those messages to just say hello to your tenants, being nice to your tenants, a good word to your tenants. And the AI is technically responding to a certain level. And he was not having to do any of those. What it did is it literally improved his aspect of tenant retention, reduced his vacancy, as well as all the elements associated with it. The tenants were acting much better, thinking that, hey, this management company, of course, not the ownership, but the management company is much more conducive and understanding to us. That one single change, even though it's in real estate, the one single thing, simple change can make a difference in your business. So if you're investing into things like that, you might be able to write off elements of those as long as you're spending those money in US to be as an R&D credit as well. And I always like to say that credits are better than deductions in most cases. So
What's
if
the
you
difference
can
between the
find
credit and the deduction?
So the deduction is you spend and you get a write-off against it. And the amount of tax that is reduced is based on the tax bracket that you're in. So say, for example, you spend $5,000 worth of deductions, but technically speaking, you're probably reducing your tax liability by $1,000. But if you get a $5,000 credit, you're literally reducing your tax liability by $5,000. So technically speaking, it's equivalent to getting a deduction of almost $20,000 on an average.
Wow.
So that's why I always say, if you can get a credit, credits are always better than deductions. So
Okay.
those are some of the things that I would say that, hey, let's take a look into it, summarize, consider the Esther loophole, the hiring kids, retirement plans, or if you're a W-2, consider 529 plans if you have kids and such. Consider looking into the infinite banking strategy, even if you're just a regular business owner or investor. In most cases, I recommend, unless you're at a point that it doesn't make sense with the payments. But other than that, I'd always recommend. And if you you can also loan the lifetime of your kids. So say, for example, someone's 60 years old. So instead of him, or 75 years old, him starting a whole life policy might not always be the best one. In that case, you pay your kids to start early with the lifetime policy, and that might be significantly lower while you get a better cash value whenever you're actually trying to get a return on investment. And Augusta rule is definitely one of them. If you have a corp, the Section 179, we discussed about that. If you're looking into any of those, and of course, if you're a real estate professional full-time into real estate, make sure to track your hours. If you're not a full-time real estate agent, but you're still into full-time into real estate, make sure to track your hours. Some of the things that I do as a tax professional, I would like to see is the property address, the date, the time spent, a little bit of description, and the type of activity that was going into it. So as long as it's more than 750 hours, we can definitely take all the depreciation, or in most cases, all the depreciation against your passive income. And last but not the least, we did speak about the R&D credit and a little bit about the home office deduction, especially if you're having even a small room separated out for your home office. Make sure to track your expenses associated with that as well. But anyways, so those are some of the things that you can still do. So we're still at November. If you are diligent enough, you still can do all of them by December 31st and get deduction.
You talked about a nonprofit, and there's also the other thing that's related to that, and the term evades me at the moment. But what is a fund? Say you're doing a fund or nonprofit or things of that nature. And I know a fund is completely different than a nonprofit, but what does one need to do to set that up in order to use that as a tax benefit? Mark Chang will get to you in just a minute.
Two different things. Funds is completely different than nonprofit.
Yeah, I know that. Fund is not the other phase I was thinking of, but it's one that
Yeah.
came to my mind. But there's something else similar to a nonprofit that's not a nonprofit.
501c3.
Possibly, but
I mean, what I was talking to him is 501c section
charity,
501c
charity.
charity has multiple sections. So you just come up with not everything that you're trying to do needs to be a 501c3. It can be multiple 1, 2, 4, 5, 20, 20, 16, whatever. So all I told them that just see your options and choose the best one. Coming back to the point is, since you brought up fund can be also something that's valuable, especially if you're doing into real estate funds or if they're doing into exploration funds. The reason that I didn't bring it up is not all the funds are created equal.
Yes.
Because if you have some funds that is actually actively investing in the exploration of oil and gas, that can be a in some cases, 1-to-1 write-off. But however, can you take all of them? Maybe not. But in some cases, maybe you can. So that's why fund is a little bit advanced area, but fund can be a really good area to still, if you contribute now, depending on how fast they move, that can be a good option as well.
Cool.
Coming back to the nonprofit, the difference between nonprofit and fund is a nonprofit, you cannot have any profit. Just by the name. You cannot have any profits distribution. You can have a salary, a reasonable salary, but as distributions, there cannot be any distributions. As opposed to funds, you are going to have distributions, profits, and losses and such. Nonprofit, however, you can contribute a significant amount. So say, for example, you made $1 million in your flipping business. If you had a nonprofit, you technically can shift almost $600,000 into a nonprofit. And now your taxable income drops from $1 million, boom, to $400,000.
400,000, yeah.
So it's much better to pay a tax on $400,000 than $1 million for sure.
Mark Chang, you are on with Tousif Rahman. What's your question?
How's it going? Thank you, JJ, for putting this together, and thank you for all the knowledge you've shared so far, Tousif. There's so many questions. I think the one I'm really interested in right now is what are the things that should be top of mind before the end of the year? The reason I ask that question is there's a couple of different filings that have been brought to my attention. And for you as a tax professional, let's just say you wanted to be a little bit more attentive to your own taxes, at least your LLCs and filings. Are there any just really good top of mind stuff to be aware of to file before the end of the year or before January 1st? Question one. And then next, before I end, I actually invited a friend, Bridget, that's here. She has amazing vision regarding a nonprofit, and I'll let her speak about that. So I'll just start with mine. Is there any really good stuff you like people to kind of take a look at before the end of the year?
The fact that you brought up filing, of course, the biggest thing, if you have not done the BOI, definitely do that. That's a $500 a month.
Yeah.
I do have a video on very basic. I think they changed it now. You guys need a login.gov ID.
Mm-hmm.
It's simple. All you do is just fill out your basic information, and it just allows you to file the BOI. But coming back to the point, are there other filings? If you're setting up any of them, like if you're setting up the self-employed retirement plan, you probably need to start looking into that. If you are setting up the Augusta rule, then probably look into that as well with the comps and such. If you're thinking of paying your kids, maybe set up the payroll. Or yourself, maybe set up the payroll as well. That's one of the things that might be on top of the filing. In terms of the R&D credits, if you have any specific payroll company, they typically help you out a lot. I do have people from ADP that they do those R&D credits.
Mm-hmm.
If you need them, let me know. And of course, if you're thinking about nonprofit, during filing, make sure to have the retroactive clauses in there, because it does allow you to contribute. However, technically speaking, on a very legal terms, you could have only contributed when it is approved by IRS.
Mhm.
But can IRS disapprove? Yes, they have the authority. But definitely, if you start the filing process, that's when it can be a consideration, as long as you have the retroactive element into it.
Awesome.
So whenever if you're filing those, that another thing. And also consider, if you're buying properties, consider the aspect of which ones you're going to be doing the costs again.
Hmm.
But along with that is definitely make sure to keep the hours log, because a lot of the times people go back and forth. Hey, I know I did it, just file it. I'm like, okay, I'm gonna file it. You need to give me a proof. If you're not willing to give me proof, I respectfully tell that, hey, you have H&R Block in your block. They're gonna be way cheaper than I am. They're gonna be maybe even faster than I am. They're not gonna ask you so many questions, but you might as well go there. The reason that I do these is, it's not that I don't want people to get the deductions. It's more like I think that, hey, if there was a audit tomorrow, the fact that you not only have your signature, I am also signing on your tax returns. Can I defend along with you? So as long as we can have reasonable, I mean, of course, can there still be IRS agent coming in that, hey, we don't believe it? Can there be? Yes. But on a reasonable ground, can we defend it? Yes. Then I'm going with it. So so the issue becomes, unless it's a matter of more than $50,000, you cannot really go into the higher courts. So say, for example, for Trump's case, he could easily go beyond, because it's a conversation of millions of dollars. But in most cases, if you're having less than $50,000, it's really difficult for someone to push it beyond the IRS tax course. So if you're below that, you're technically in some cases expecting, in case of the worst case, is hopefully whoever the agent comes in is reasonable enough to understand my reasoning on that. Of course, if you have a reasonable cause and background, in most cases, you will see most of the people being reasonable that we can take the deductions. But just in case nothing goes south, no one can 100% agree. That's why even if you go with the tax planning, different high-end lawyers, they do give you a option to pay with insurance, with what's it called? Audit protection insurance. It's because they go ahead and pay an insurance with their structure, and still the fact, as I mentioned, can IRS come in and say that, hey, we didn't agree with it? That's the point, that the reason that they're actually paying the insurance to.
Awesome. Thank you so much for all that. And if I can ask anything, JJ, if I can bring Bridget in, because I kind of roped her in. She has an amazing question and a vision. If that would be okay with you, JJ.
Bridget? You don't mean Bridget Ruiz, do you?
Yes.
Hey, Bridget, how are you, girl? What's your question?
Good. I'm doing well. Thank you. Thanks for hosting this, JJ. I have a real quick question, because my business partner and I have acquired properties that are for sober living. And we've considered the ideas of nonprofit, right? So of course, if I understand correctly, you were sharing that 501c3s, right? You can there's a variety of sections underneath, obviously, right, within those regulations. But does it make sense? Because the properties have yet to become like fully operational. If it becomes nonprofit, do you do it, before those assets are actually performing, or even after the fact? Can those still become part of like the creation of a nonprofit kind of after?
Apparently, yes. Do I always want to do it? No. Because, say, for example, depending on how you're investing it, the reason that I bring it up is there's something also included in myself donating to the nonprofit. So technically, because the nonprofit does not have to have, that's the entire purpose is the exemption status. So unless there is certain higher level rules are met, it's typically an informational return. So up until that point, technically speaking, whatever you're transferring from yourself to there is called, in some cases, you would ideally want to keep that as a donation, because on your personal side, you're going to get more of the deductions. So technically speaking, can it be done? Yes. Am I going to be doing it? No. That's an investor to investor conversation as opposed to a legal side.
Sure. So then, for example, the nonprofit exists and the intention to acquire properties for the nonprofit is different than, say, we donated a property to this nonprofit. Is that correct?
Now you're bringing into another gray area, to be honest. So I would not always say that it's an intention. The moment you bring in an intention, it sometimes bars you to take some of the benefits. So now, of course, can you speak out an intention? Yes. Do I speak out intention in every case? No. Because why not? Because I'm going to decide what is going to be the most beneficial for each instances. This is the reason that I personally try to see every instance as unique, because say, for example, you started a sober living business and you needed the bonus for that specific year, but the amount of money that you raised in the nonprofit is not that much. So if I were you, I would probably take the bonus, take my taxes out, and after that, donate it there. Why leave the money on the table? Because at the end of the day, it doesn't matter how much they're making. I mean, of course, there are some limits unless it's a huge thing. In the most cases at the beginning, it is not going to be paying any taxes. It's just a regular corporation. And the entire structure is a corporate structure, C Corp structure, because with what it does, it literally separates you from the nonprofit. No one owns a nonprofit. So you never own an asset in nonprofit. The moment you get it in there, if you ever wanted to control it back, you would have to buy it.
Oh,
It would be a complete sale, just like a C Corp. Of course, can you as a shareholder contribute it? Yes. It does change your basis. It does change all the other calculations. But in most cases, moving in and out of a full C corporation, in many cases, it does treat as a sale. Same thing. If you're setting up a nonprofit, you will go into setting up a corporation first, then apply for the nonprofit status as an exemption. That's the entire thing that I was told that it takes about 8 to 10 months now. So to answer your question, can I do it? You can do in most cases whatever you want in America, but is it always the best thing to do? I wouldn't say so.
Thank you.
Brother Tousif, man, that's gold nuggets constantly, just dropping them.
Yeah, nonprofit is something that it's a fresh thing for me since I'm also in the process of doing nonprofit myself. So there are challenges that's going to come up and down, up and down. I can probably speak about those on a separate thing, but nonprofits is a very good way. Just make sure you're not overstretching yourself. However, don't misuse any of the strategies. Use the strategies, don't misuse anything. Because there have been cases of nonprofit fraud that IRS is going after now. Because as I mentioned, if you don't have a proper vision, the same thing for LLCs. People just say that, hey, if I open an LLC, I can get a tax write-off. You just don't open a business just for the heck of tax write-off. The purpose is the money-making aspect. You get the write-offs along with it. So as a business owner myself, I don't always see the tax write-off first. It is one of the top things, but it's not the first thing. The first thing is the purpose. Am I able to make money, or am I able to make a difference? As long as those are there, then move along with the action that you're going to be taking in.
That's awesome. And I'd love to talk about the nonprofits. I mean, that's as you said, a whole nother conversation. I'd like probably when we talk about that, could we also talk about charities? Because
Nonprofit is the
those are
charity.
very similar, right?
I mean, in most cases, the same thing. The only difference sometimes it does become to have a little bit of more advanced is family foundations and non-charitable trusts that I can think on top of my head.
Okay.
The reason that they're a little bit different but similar is on a charitable family trust, the starting point is typically at higher asset class or amount or contribution class. That's why you see most of the things done with big people is Gates Foundation.
And as you mentioned foundation earlier, when I said funds, starting with F, I meant foundations, and the word
Okay.
evaded me at the moment. But yeah, we're talking about nonprofits, we're talking about charities, we're talking about foundations, and there are a variety of platforms that can be incorporated, guys, to as Tosa says, when used properly. We're not trying to talk to anybody about sidestepping any legalities. This is not financial consultation. We're not giving, we're not having this. It's more of a Q&A on a topic, as
Yes.
opposed to this is not professional advice on tax planning.
This is just a chit chat with my rich friend JJ.
There you
That's it.
go. Brother, gold, absolute gold as always. I think this is what, your second, third time? At least your second
Second
time.
time.
Yeah, so we'll continue. As you said, there are other topics. We talk about taxes. There's a wide variety of topics. My accountant Narg Niazi is going to be on in a few weeks to also talk about things from a tax accounting standpoint. And again, I want to connect you two guys. Um,
Sure.
I thank you so much for joining us. I wanted to ask you again, and let me
Maybe
uh,
we can have a separate calls on just charities and international investment sometime, because those are the two things that I'm personally studying and digging into myself as I am getting myself into the crux and making my own stuff set up.
there you go. Um, so two last questions for you, brother, before we check out of here. If people want to get a hold of you, they're watching on YouTube, they're watching this video right now on YouTube, weeks and months down the line. What's the best way to reach you? Is it your MySpace page, your TikTok, Snapchat,
Text or Facebook.
Mr. Tousif Rahman himself? And guys, if you're on the page, please feel free to send him a message on Facebook that you were on today. But we've got a bunch of mutual friends. He does have his friends as private. I love that. But again, this is Tousif's Facebook page. If anyone's curious, make sure you have the right page. This is his page. My last question to you before we go into the little breakout rooms and do some chit chat and Narg, if you're around, stay around. I'd love to introduce you offline. Um, but my last question is, I have a networking group, and I'm always talking about the importance of building relationships and networking for real estate investment. There are so many education groups out there. Sub2 is only one of many, probably over 100 at least, education platforms of people promoting different types of aspects of real estate education. There are many people coming every single day to these programs that are either brand new to investment or extremely experienced to investment, but now coming to these education platforms and the social media platform for the very first time, using social media as a networking tool for business. For the real estate investor, whether they be brand new or experienced, in your opinion, what is the importance of networking using social media to build one's business?
If you're planning on doing scalable business at the 21st century, you need a social media. I'm developing myself. Of course, I'm not the best one in social media, to be honest. But just to give you a simple example, I scaled my business to a certain point in a year and a half only through social media, which took some of my peers to reach my level at least 5 to 10 years without the social media. So literally buying back time if you're able to use social media properly. I left my 9 to 5 jobs 2 months ago, literally 2 months ago, as a mechanical engineer. And the reason that was able to, I would say that scalability allowed me to reach out to people, say, for example, from Alaska. An interesting example, my local religious environment people are saying, hey, why don't you promote them into this local religious groups? I'm like, there's other people there, but they're saying, but they're not teaching us all the strategies that you're teaching for free. So I said, you see, I'm not after the same exact people here, because the moment you're into social media, I'm able to file taxes for people in Hawaii and Alaska, despite being in the East Coast next to DC. And the moment I go there, I go into any of the tax groups, I'm able to give actual quality free advice, not fearing the loss of my business. And the way you do it is through social media. So I don't know how else to explain it.
There you go. Yeah, and one of the things I say all the time, guys, is networking done properly leads to visibility.
Yes.
Visibility done properly leads to opportunity. And we all want the same thing. You and I want the exact same thing. We want the opportunity to build relationships with successful people that will help us, predominantly because they like us. So we need to use social media to build relationships, because the best business relationship is a personal friendship. I will help
Absolutely.
anybody, but if you're my friend, I'm going to help you more. So Chris
All of
Richardson,
my deals are also in social media.
there you go. Chris Richardson, you and I got to get to be friends, brother. Hey, if you guys are watching on YouTube right now, thank you for watching. Please like, toast this video. Please put your takeaways and comments in the bottom section, in the comment section there. If you guys are on the call right now, do not go away. We're going to come back with some gold nuggets of our own, separate from the recording. And again, if you want to connect with Tousif, guys, you want to go to his Facebook page, which is right there. Here's his Facebook page, Tousif Rahman, EA, MTR Groups. That is his Facebook page. Send him a message there. That's where you get hold of him. If you want to join my group, if you want to network with me, see all our guest speakers coming up, guys. Scan this turquoise QR code here. Go to my website, register for my group. Chris, there he is, Chris Richardson. Scan that QR code, register for my group. If you guys don't yet know about my YouTube channel, scan the purple QR code, guys, here, and subscribe to the YouTube channel. See all these great videos. Maybe not as great as Tousif, but awesome, great speakers coming up. I've got over 300 videos of quality content. You won't find anything like it anywhere else. Tousif, thank you so much, brother. For everybody else on social media and watching on YouTube, we'll see them all out in the world of virtual networking, right? Virtual social media, right?
Absolutely.
Thank
you very much, JJ. Have a good one.
Thank you, everybody.